Hey everybody, welcome back to the channel. Joining with me today is Maxwell Baity.
Hello.
Maxwell works for Senior Savings Network for a long time now, but he has taken a focus in the recent time to study in depth into the other financial solutions that our clients often ask us about. So he's become an expert with a team behind him of experts to answer a lot of the financial questions that you've been sending in. So let's just jump into a couple of those questions. This was submitted by one of our clients. I'm planning for my mother's Medicare and long-term care, and it is quite stressful, obviously. What is some advice to make this process more manageable, both looking at the Medicare, but also considering long-term care?
Yeah, I would start off by saying breathe. It is a lot to try to do in one conversation. The best way to normally start the conversation, let's go piece by piece. Let's make sure we know what's priority number one. When it comes to Medicare, it's not all fluid of you can get everything done at once, potentially, if you got everything taken care of already. So it's going to be very important to know exactly where you're at with the process. Are they under 65, turning 65? Are they over 65 and retiring? So there can be additional steps that your parents may have to take. So knowing what step you're on, and then we'll execute the next step and we'll tell you what would be next from there.
What's a common misperception that our Medicare clients have about long-term care?
Yeah, long-term care, it's a side of when they hear care, they believe Medicare is always going to take care of it, right? That's going to be more on the side of short-term care. If you had more of a hospitalization for at least 3 days, that's where you're going to get more of the skilled nursing side of care. Mm-hmm. That's only going to be limited depending on what you have. If it's original Medicare, it's up to 20 days. Supplements, you can get an additional 80 to bring it to 100. Again, we're still only focused on the short-term care side. Long-term care is the area, or custodial care is still the area where Medicare does not cover. And that's where, again, executing a perfect game plan for your scenario to really understand what are the areas or gaps, in a better sense, of what's there to really fill in, because in this area, long-term care is usually the biggest or one of the biggest that people are not aware where Medicare does not cover at all.
What are some of the options that people have? Let's say they're retiring at 65, they're doing their Medicare solution, and now they're a Medicare client with us, and they've saved for their retirement. Maybe they have a 401k, they have a house that's paid off. What are some of their options to address the long-term care implications that they may encounter later in life?
Yeah, it's more of, again, just understanding what you've done so far in your retirement, what do you have set aside, and really understand your general area as well. It's really going to be a determining factor of where you live and where you want to live, if you do have to move, or if you want care at home. What's the cost of an hourly wage nurse in that general area? So knowing your desired location is going to be a big factor when it comes to knowing what long-term care could cost you. Now, with that extra set of savings that you may have from retirement, that's where we're going to be a big indicator of what are you using it for, how can we make sure we're maximizing it and still using it for those type of vehicles like long-term care, where there are strategies now where you can take advantage of a retirement vehicle that can support you on the long-term care side.
Back in the 1980s, back in the 1990s, long-term care insurance, like through John Hancock and GE, that was a big thing, and people swore by it because it was great. It was affordable. People could get qualified for it. And then in the last 10 years, we've seen company after company just disappearing from the long-term care space, even though our clients have been paying into that thing for 10, 15 years, and they're just gone. So besides the typical long-term care insurance, which is hard to get qualified for and very expensive, and then they can change the premium on that anytime, what are some other avenues that we can use to address long-term care costs?
Yeah, and statistically speaking, to that point, in the last 10 years, it's actually gotten harder to get approved. Statistically, long-term care approval is less than 50% now, which is staggering. I mean, it's a pretty big indicator where less than half the people that are applying are not going to get approved. Now, there are areas of short-term care that gives you that support, but if we are looking more on the long-term care side planning again, the other vehicles that we can take advantage of taking a look at that have been modernized is actually life insurance in some vehicles. There are some opportunities where you can borrow from the death benefit, and with that said, it's a death benefit, it's tax-free. If you're not able to perform the same way as a long-term care pays out, which is if you're not able to perform 2 out of the 6 activities of daily living. So you're bathing, you're dressing, you're eating, toileting, etc. So they still execute and operate the same way of how a normal long-term care plan works. It's a lot easier to get approved for. And there's actually now something left for a spouse. As you indicated, you could be paying into this for 10, 15, 20 plus years. if you were to pass away, what's left for the significant other that's in your life? Nothing.
Right.
Now with a long-term care or long-term care and a life insurance play, you can borrow from the account death benefit if there's a long-term care need, which again is if you're not able to perform those activities of daily living. But if you didn't have to use it anymore, it goes back to a regular life insurance policy that now something is left for your significant other as a death benefit. That's just one vehicle. I did mention a second ago as well, there's actually a way you can take advantage in other type of retirement vehicles like certain fixed index annuities, where again, it's the same operating figure of if you're not able to perform those activities of daily living, that's how those plans perform. And there's multiple plans we could take a look at to really understand which one is best suited for your needs. It's really of what benefit is more important to you. But that being said, there are thankfully more vehicles than the regular old traditional long-term care play, which again, very expensive. Either you had it for 15, 20 plus years and didn't use it, which at the low cost, that's great, you got it early, but you never used it, or you're getting it now that's triple, quadruple the price that it would have been if you bought it 10 years ago. And the last part is, if you were to pass away, what's that left for anybody else? You just paid into that for 15, 20 years and they say, have a nice day.
What's refreshing to me and what I'm hearing you say is that there's not a one-size-fits-all solution to everybody. We start by listening and seeing what their priorities are, what their concerns are, how much they have set aside for retirement, and how we can best strategize that to take the long-term care risk off the table.
Yeah, there's not a perfect system. There's not a one fluid answer to the problem. It all varies on what is your biggest need, and that's where we come in, and I still have the full belief that we're always going to be educating first. It's always making sure what is your situation, you tell me what's going on, and that's where we can really understand the full picture. End of the day, we're going to tell you what could make sense for you, but it's still your job to tell us if that's the best option for you. We're going to be able to tell you what's available, but again, it's all going to vary based on what is your biggest need.
We've had some clients recently, as we let them know that we have access to other financial products in retirement, they've reached out to you, they've made appointments, and they've found solutions for them that really put them at peace. They have guarantees now where they didn't before. Maybe they were exposed to the market 100% with all their retirement savings. Can you share with us one or two of those stories? And
Yeah, absolutely. The big area too is where I have full belief on you were able to take advantage of a lot of time period in your life to be aggressive. Be in the stock market side of trying to maximize your portfolio at best times. If we're talking about once you're 65 and 70, if you have the same downfall of market volatility, it's basically a double hit now, because now you have the loss and you don't have the time to play catch up. So that's where, again, we do absolutely believe a guarantee route is always going to be more beneficial in this time frame, so you at least know what's coming in. It's, again, a contractual obligation to a point. You're going to get what is being offered. So some of the areas that actually were a great opportunity for people, as much as the stock market side is always the market volatility being the biggest concern, what actually has been is where a lot of our clients have been very financially smart in the last few years of taking advantage of what's been in front of them, which has been those money market accounts, those high yield savings that were doing very well the last year. So props to everybody that's been taking advantage of. Time changes, and there's a new vehicle now that you could take a little bit more advantage of what's happening now in those same accounts that have been dropping this past year. So as much as it's been a very reliable vehicle for you the past 2 or 3 years, you are now starting to see where it is dropping. So why not pivot while you still have time to take advantage if you're somebody with certain accounts where you still have to pay out once you're 73 with RMDs. That's where, again, you just can pivot to a different direction. Even though you did everything correct the last couple of years, this is just trying to still stay a step ahead.
So many seniors that I've talked to over the last 25 years have thought that the best place for their retirement funds, if it's not just in a 401k, is in a CD at their local bank. What are some issues that come up with just having your money in a local CD? Yeah,
if you're thinking long-term, CDs may not necessarily be the first option to consider. It's always enticing when you hear a CD that can maximize a 7, 8, or 10% plus return in 12 to 18 months, which is what they average, right? You don't really see what happens after it matures. You don't recognize where not all that interest is still coming back to you. You still have to pay your part and then acquire that CD back. So you're not necessarily getting that full 4.5% that it may have the gains on. After everything, that may have been turned into 3%. And again, where if you're thinking more long term, The longest period on average now you're usually seeing is 12 to 18 months. So it's a great opportunity for short term, but more importantly, there's also still better vehicles now where it's not going through a bank with the same time frame, if not a little bit longer, to maximize the maturity of the policy, which will be more of, you can be more of an idea of laddering, where if you wanted something to mature in 2 years, and then you want another vehicle to mature in 4 and 6+ years, it's a different vehicle that you can take advantage of, where it's still not, you're losing that interest gain once you start pulling out from the account.
One of the things I'm fascinated about that you've been able to help our clients with is the opportunity to participate still in the market gains when they happen, but like you said before, the critical guarantee that they're not going to lose their actual principal. I heard a very successful man once say, it's not so much the return on my money as it is the return of my money.
Yeah.
And in our senior world, losing their principal that they've saved up their whole lives it could just be catastrophic to them, and they could outlive their money. So what are some of these strategies that you've found and implemented with our clients where they can participate in some of the market gain, but yet not lose their principal?
Yeah, and I think that's really most likely the biggest part that we focus on. As much as you're going to tell us what is your biggest need, is it supplementing more income? Is it just to satisfy your RMDs? Or is it taking advantage of using your retirement savings and going more on trips? Or leaving a legacy? And legacy can mean several things, like grandkid, kids, church, organization. But every one of those conversations, it goes back to where we are protecting, which is the principal. The big idea is making sure the money that you put in is what is at least coming back out, and you just get to be a part of the gains. So the reason why it's principal protected, that's the funds that may allow your account to grow. It's not the money that they're touching. So with the funds not being yours, that's where your principal, the worst case scenario can ever be, is zero. You have that protection right there. This is just an opportunity now. You could actually just acquire gains for a period of time.
I like that a lot. So you're saying that they can participate in the growth, the continued growth of the market to the point that it does grow. But if we have a massive market correction, like so many people have been predicting, now they're saying it's going to be the AI or the tech space and things, and people want to ride those really hot stocks right now. But as we're in our 70s and we're in our 80s, is that really a good idea? Where they could still participate in some of the gain of the market, but if the market had a 20, 30% correction, with the clients that you've already helped, and you put them in these guaranteed spots, what would happen to their principal if the market did have a correction of 20, 30%?
They'd continue to move forward of where we left off when we first signed up. That's where, again, where if you put in $100,000, you know by the end of maturity, the base is still going to be $100,000. So it's absolutely true where you get to be a part of the actual gains, where if there's a win on the policy, there's a win with you. That's where the protection really comes in, where this is an opportunity to control your risk. And that's where you were you were able to have more opportunities to be aggressive in life. And this is just your opportunity to get what is actually being offered to you, not a possibility of it could get to this number, where in this scenario is you are getting the number that we're being talked about.
And one of the things that people would often say, because I've heard this, if they're saying that sounds too good to be true. So if the market goes up, my account value goes up. But if the market goes down, I can't lose my principal. So how does that work? If I ever want to access my money, is it locked away for 10 or 20 years and I can never touch my money again, and I can just watch that account value go up, but it never means anything to me? What would you say to that?
Thankfully, no. It depends on, again, the type of vehicle that we're looking at, but more importantly, every vehicle is going to allow you to have free withdrawals every year. That's where you're never locking up your funds. So that's never going to be a case where you can't come to me or the product and say, I'm needing to pull this amount, and what am I going to have to charge for? Thankfully, you're always going to have that vehicle allow you to pull from your funds every single year. And so that's never going to be an issue where your funds are going to be fully locked down.
Another topic, but kind of interesting, I heard recently a friend of mine had a life insurance policy on an older relative. It was a significant death benefit, but she came into the part of her life where she needed to access more funds. She actually needed some renovations done in her home so that she could stay at home. She did not want to go to a facility. But she had this valuable life insurance policy that she just quit paying the premiums on, and so this $1 million death benefit just vaporized. And everything that she'd put in up to that point, you stop paying the premiums, and at a certain point, the policy just goes away. What is another solution that they could access where if they've got a life insurance policy, they've been paying for it all the way up into their 60s, 70s, and 80s, and now they realize, wait a minute, my kids are okay, my spouse is okay, the house is paid off, we've got other assets, I don't need it for grandkids, I don't need it to give it away. What can they do with that rather than just stop paying premiums and let the whole thing vaporize?
Everything went the right way, right? Everything went the right direction,
Right.
where you did something to have a backup plan, which more props to you just to be ready for the inevitable or just anything in general. Thankfully, at this time period where a lot of people just don't necessarily know, is you can take opportunities of, if there's a certain type of policy you know you're not going to want to keep up with on a premium basis, or unfortunately financially it doesn't fit your balance anymore. There are opportunities now where you can take advantage of someone actually buying that off of you, and depending on what they perceive of how long you were going to live, you get a lump sum for that account. So there's never a time period where you just give up on a policy, where you can take advantage of giving that up, but you at least have something coming from it. And now you have a little bit excess of using for other means again. What do you want to use those funds for? Is it just putting into your savings, or is it still maximizing, like you said, maybe you still have grandkids you want to protect that has a separate vehicle once you were to pass away? Now that's an individual account that you can allow grow into a certain vehicle that can guarantee certain amounts every year.
So just to wrap up, if you have money that you're putting into CDs because you've enjoyed up to this point high interest rates, and you're looking for a better tax advantage vehicle that could pay more with guarantees, or you're one of those people who are too heavily invested in the market, you feel like you're overexposed but you don't know to what extent, you'd like another opinion on guarantees and how you could take some of that money off the table, still participate in those gains, but at the same time have a base level of principal that is never going to be touched. Or let's say you've applied for long-term care because you recognize maybe with your family history that's a concern for you and your spouse. There are other vehicles besides the one that you can just find maybe in an AARP magazine that if you go through an independent broker, we have access to tools and strategies that you just may not be aware of, and it's worth a conversation. Or if you have a life insurance policy that you've had for so long to protect your family and now it's become unaffordable, it's not part of your budget, but could you actually maximize that, turn it into cash right now, because that is a legitimate way to plan for your future. Those are things that Maxwell and the Senior Savings Network can continue to help you with. So reach out if any of those strategies are something you'd like to explore. Thanks for watching. Have a great day.